The housing market is going to crash. Or is it? Holy moly. So if you spend too much time on Twitter and YouTube like I do, then you're almost certainly convinced that a financial crisis is coming because everyone and their mother is now predicting it. But let's take a big step back and look at the data objectively and see if we can come to our own conclusions here. Okay, so backing up a little bit, the typical housing expansion really hasn't been that long. So the current boom really is a big one, both in terms of timeline and price change. And the housing market's really been on fire in the last 10 years with a 100% increase since 2012. Housing and everything related to housing is over 20% of US GDP. So this is a really problematic aspect if we're on the verge of a crash or even just a housing slowdown. 70% of all household debt is mortgage-related debt, which is why a big downturn in housing is so crippling for the broader economy. The surging home prices weren't such a big problem when interest rates were low, but now that the Fed has jacked up rates to respond to inflation, we've seen more than a doubling in mortgage rates. And so something has to give here. Either home prices need to fall to adjust to demand, or interest rates need to come back down to prior levels. This chart from Redfin of monthly average mortgage payments puts this nicely in perspective. This chart of average monthly mortgage payments shows a 50% increase in the average monthly mortgage payment since 2020, whereas disposable personal incomes have increased by just 12%. So we're either going through a massive repricing of housing here, or these data sets are going to mean revert to some degree. And I think that's most likely to occur through the monthly mortgage payment declining a bit. Most existing and new home buyers simply aren't willing to accept a rate over 6% because it's unaffordable. The surge in mortgage rates creates a pricing paradox, though, because surging rates are terrible for new demand, but we also shouldn't expect to see a huge surge in supply because a lot of the existing homeowners simply won't trade up for the new mortgage rate. So even though inventory has crept up, we're still nowhere near historical levels. Another huge difference between now and 2008 is that we just don't have the adjustable rate mortgage problem we had back then, which caused a huge flood of supply on the market and forced sellers. A lot of the forced selling during the financial crisis was due to the fact that you had that huge surge in subprime, low-quality borrowing. We just haven't experienced that this time around. This difference can clearly be seen in the mortgage delinquency rate. All that said, the bottom line is that 6% mortgage rates are too unaffordable for too many millions of people, which means that pricing is going to be soft. One of my favorite indicators to follow this is the ratio of rent prices versus housing prices, and these are typically mean reverting ratios. People have to choose to live somewhere, and so rents tend to put a natural floor under house prices to some degree. This is likely to mean revert in both directions, and so I think we're likely to see house prices fall somewhere in the neighborhood of 10 to 15% as rents converge upwards. This is consistent with this chart from Nordea and Macrobond, which shows the lending rate in the months of supply inverted relative to the Case-Shiller house price index. But I think that 10% downturn is likely to occur over the course of several years because unlike 2008, you just don't have that forced seller aspect that made everything so much more panicky. So I think the comparisons to 2008 are hyperbolic. We're not in for a financial crisis 2.0, but that doesn't mean that house prices can't be very soft and potentially fall 10 to 15% in the coming years, resulting in what will feel like a continued recession. Whoa. It looks like all that Fed money printing is making these 3-minute videos longer and longer. Guys, thanks for watching. If you like the videos, please like, subscribe, or leave a comment for me.